My name is Alan Gauld, and I'm the lead portfolio manager of Aberdeen Private Equity Opportunities Trust and a senior investment director in the Aberdeen Private Equity team. Now, in terms of the trust itself, I'm going to sound a little bit like a broken record, but its strategy with Aberdeen Private Equity Opportunities Trust, or APEO as we call it, has been consistent really over the last couple of decades and since its launch in 2001. And we don't try and time the market. Private equity tends to make a number of its best investments during periods of uncertainty and market volatility, when more differentiated new opportunities become available, whether that is, for example, long-held family-owned businesses or corporate carve-outs or public to privates. And generally, in these times, the entry pricing, the ask for these businesses is more reasonable compared to the more recent times we've seen. But the trust itself continues to be focused on Europe. It continues to be focused on the mid-market buyout segment of the private equity market. So nothing has changed there. That's been the case for over 20 years. And that means that we're focusing by and large on institutional, profitable, cash-generative businesses that are majority-owned by a PE firm that we've partnered with. We have over 650 private companies in the portfolio now. And in terms of sector, nothing's really changed in the last few quarters. Technology and healthcare remain our two top sectors at around 20% of the portfolio each. Healthcare slightly ahead. But beyond that, the rest of the portfolio is pretty well balanced between consumer discretionary, consumer staples, industrials, which includes B2B service businesses, and then also financials, which includes fintech. But probably the key thing to mention, as we've mentioned over the last few quarters, is around co-investments. So at the start of 2019, we introduced co-investments to the investment objective of the trust. And then we began to make these co-investments. Now, it was a logical thing for us to do because our team had been making co-investments for a couple of decades. So it was just a logical step to include it in the trust. And the advantage of co-investments, the advantages are or include the fact that they are direct into the companies. So you're cutting out a layer of fees, and that creates the possibility, if you get it right, of being accretive to the overall NAV returns of the trust. So co-investments equate to around 21% of the portfolio as we speak today across 24 co-investments, and we aim to grow that even further. So the trust recently reported all its valuations at the 31st of December 2022. So that resulted in an uplift of around 2.3% quarter on quarter in constant currency. However, in the period, sterling also appreciated against the dollar and the euro, creating a sort of FX headwind. So overall, we saw NAV growth of 1.7% in that quarter, which we're pretty happy about given sort of the wider market uncertainties and some volatility that we've seen more broadly. So we consider that good performance, and that builds on the last financial year performance of a NAV total return of 14.1%. So pretty pleasing overall. And then from a share price perspective, obviously we saw a lot of negative sentiment around private equity and frankly investment trusts in general last year, and the share price went in the wrong direction. But really since the start of the financial year, which is the 1st of October 2022, we've seen the share price recover somewhat. So from the start of the financial year to the end of April, the share price total return is just over 16%. So some recovery underway, albeit the discount, the share price discount to NAV still remains quite wide at levels we've only really seen in the global financial crisis and at the start of the global pandemic. So the discount in the trust and many private equity trusts, in fact, remains around 40%, which is pretty wide. And we hope that closes in as the market gets more certainty about more macro issues, interest rates, inflation, and the like. From a new investment point of view, we continue to be active. As mentioned earlier, we don't try and market time, so we'll be consistent in our deployment. And we've deployed or committed to 5 new private equity funds during the financial year so far. Funds managed by core private equity relationships of ours, the likes of HG, Altor, Vitruvian, and Seidler. So we're really excited about those. But in addition, we've been active on the co-investment front. We've made 2 new co-investments and 2 follow-on commitments to co-investments that are already in the book. So in terms of the 2 new co-investments, one is to a US headquartered consumer business focused on children's entertainment and education. Unfortunately, we can't publicly disclose the name of that company right now, just for confidentiality reasons, but we're really excited about that one. And then the second new co-investment is into a business called Doc Planner, which is a business that provides software to doctors, clinics, hospitals, and importantly, patients, which improve the end-to-end experience for patients. So we're excited about that one as well. That one's alongside One Peak. So yeah, and then more broadly, balance sheets. We have around 227 million of liquid resources, i.e. cash and undrawn revolving credit facility available to us, and outstanding commitments of around 683 million, which is in line with 6 months ago and at the lower end of our over-commitment ratio range of 30 to 75 million. So we feel like we're in a good place in these choppier waters. And then lastly, I would mention dividend. So the company pays a quarterly dividend and recently announced a total dividend of 16 pence per share for the financial year 2023. That is an 11% uplift on the prior year and represents a dividend yield of around 3.5% at today's share price. And recently paid the first quarterly dividend for financial year 2023 in April, and the next announcement around the quarterly dividend will be in June. So that would be the sort of key updates. So the portfolio has remained pretty consistent as it has done the last few quarters. But I guess building on what I mentioned at the outset, co-investment remains the sort of key development over the last 2 or 3 years. And co-investment has increased to 21% of the portfolio as at the 31st of December 2022. And that's an uplift from 11% at the end of financial year 21. So quite a strong uplift in the portfolio in terms of both new investments but also valuation growth. In the last financial year, for example, the co-investment portfolio grew its valuation by 58%. So we're really happy with performance there so far. And we have a portfolio now of around 24 co-investments, and we expect this will be 25 imminently. And the idea is to build a portfolio of around 30 co-investments at any one time, around about 25% of the portfolio. And we aim to do that over the next couple of years or so, get to that level. Aside from co-investment, key development in the period has been the sort of increase in our revolving credit facility from 200 million to 300 million. That gives us extra firepower for new investments and extra protection during this period of volatility. So we're really happy from the strong support from our lenders, RBS International, State Street, and Societe Generale. So very pleased about that. So we've talked a lot about our strong technology and healthcare exposure in the portfolio and used a lot of examples in previous updates there. I thought we'd go in a different direction this time and talk about a couple of our co-investments in the consumer staples space for a bit of a change, I guess. So the first one of those would be Action, which is the Trust's largest single company exposure. And here we partnered with 3i, originally in 2011, all the way back then, through their fund 3i Eurofund 5, which invested into Action back then. And it was a fantastic investment for that fund and returned around 30 times original money. And we got an opportunity to reinvest into the business in 2019 through a co-investment, which we took advantage of. Now, Action is a discount retailer, and many of you will be familiar with it, given it's a large proportion of 3i's listed investment trust. But Action covers a number of different categories, so non-perishable food, gardening equipment, DIY equipment, sports, pets, across a range of things. And it's a combination of brands, but also their own label products as well. Now, the secret sauce here is that a lot of the offers that Action provides customers are one time only or rare offers. When they're gone, they're gone. And that creates a loyal customer following, customers that come back on a weekly basis or even more frequent than that. And the business started and was founded in the Netherlands, successfully expanded into France, and now has over 2,000 stores across 10 different countries across continental Europe. So it's expanded very, very well, and its concept has translated across different geographic boundaries. The value creation is really continuing this strong store rollout whilst improving the operational metrics in the business. And as it scales, as it gets bigger, it becomes more efficient and more powerful, and gains advantages around things like the sourcing of products in the supply chain. So it's a fantastic concept, working very well, performing very well. We're very happy to be long-term holders of this business. But then for another example in our co-investment book in the consumer staples space, is a business we invested in last year called Uvesco, which is a leading regional grocer in northern Spain. So think the more kind of prosperous regions in the Basque Country, Cantabria, Navarra, La Rioja, those sort of regions it has strong presence in. And we partnered with PEI Partners here, which is a long-term core relationship of ours, and is very specialized in the food sector, along with the founding families and the management team of the business. And we think this business is differentiated by its sort of higher end offering, which centers around local produce at the heart, of their stores. So, pretty interesting grocer. And then we also think we bought quite well here in terms of entry price. And the opportunity is to increase the company's presence across northern Spain, but also into the sort of larger areas, in Madrid and the surrounding area, Barcelona as well. And that might be through M&A. It's worth pointing out that the Spanish grocery market is one of the most fragmented in Europe. So there is a sort of buy and build opportunity, so to speak, here, as well as the potential for lots of operational improvements as well, in purchasing, for example, in digitizing the business as well in some respects. So those are areas that PEI will certainly be able to support this business, given its strong experience in the sector. And then finally, I would say in terms of when it comes time to sell this business, there's a lot of optionality here. This business could be attractive for a large supermarket group, for example, but equally it could be attractive for a larger private equity firm who would like to continue the consolidation efforts at the business. So another one we're excited about and has had a strong start. The first thing I would reiterate is that we're not trying to market time here. We're looking to consistently deploy across the cycle. It is cliched, but money does tend to flow into the private equity market at the wrong time, i.e. at the height of the market, and then flow out at the wrong time, i.e. at cyclical troughs. So we try to remain consistent to capture the best opportunities throughout the cycle. And in that vein, we will continue to back private equity managers that we have strong conviction in, core managers, through their funds. Typically funds that are and managers that are more sector specialized, and typically those that are perhaps a little bit more focused at the lower end of the market, where from a relative point of view, less capital has been raised in recent times. Competition isn't as fierce and as institutionalized as sort of the larger end of the market, and the businesses would benefit from private equity support in quite a big way, and there's lots of value creation opportunities as a result. So we'll continue to focus on that as we have done over the last few years. I've mentioned co-investments a couple of times. We'll continue to grow that to a portfolio of around 30 co-investments and equating to around 25% of the portfolio over the short to medium term. And then lastly, on secondaries, we think there could be an opportunity here. We think there'll be some distressed sellers for various reasons. And we have a team in place that are ready to opportunistically take advantage of that and buy high quality fund positions in the market from other investors. So those are the areas that we will be focused on in the coming months ahead.